Hi, welcome back to WOW, the Wealth Optimization Workshops. Delighted to have you back. We're talking all kinds of different topics here. When we get back to our financial planning concept to build a holistic financial plan. Again, we know you want to deal with the fun stuff, the controllable priorities, investment strategies, retirement planning, and we're going to dive deep into that. But we need to deal with the non-controllables first. Just talked in the previous episode about the needs for life insurance and where it fits. Now we're going to touch on a couple different types. There's literally hundreds of different plans, and the mechanics of the plan designs are a little different from one to another, one company to another, one product to another, but ultimately they fit into two major categories: term coverage and permanent or perm coverage. We're going to dive into some intricacies like universal life, protecting your mortgage, participating plans, and some of the tax and retirement related strategies you can use those types of plans for in future episodes. But we want to get just the fundamentals today. Why term versus permanent? What's the differences? So let's take a look here. You got your morbidity when it comes to health issues, mortality when it comes to dying prematurely, and age. How many years into the future? If you think of that as your mortality or morbidity curve, what's the likelihood of something happening at a certain age? Hope this makes sense for you. So do 2-year-olds ever pass away? Unfortunately, yes. My brother did, but it's not very common. So the risks are lower. But if you're more middle age and you're 40, well, greater risk, but odds are still pretty good you're getting home safe today. But you never know. So we do have to protect against health risks or accidents there. But if you're 95, you're going any day. Right? So the older people get, the less likely they can even qualify. Some young people can't qualify for plans either. We'll talk more about insurability later. But if you're old enough, there's no way that you're going to be able to get a plan. So the younger you do it, when your health is better and your age is preferable, the better it'll be for you. Okay, so we're going to take a look at a couple examples. Let's say it's a 10-year term. And sometimes people love that. Oh, I only like term because it's cheaper. It's cheaper up front. Okay, so in the first 10 years, you have a guaranteed level cost for 10 years. However, 10 years from now, if you need to renew that plan, it's going to take a big jump with your age. And if you keep renewing it, what started out as very economical, later on in life becomes astronomically expensive. Right? Now you can get different term lengths. For example, let's say it's a 20-year term. It means you pay a little more in the first 10 years, but a lot less in the next 10 years. But then it's still going to have that jump. How about a term 30? Same type of idea. Does that make sense? Hopefully you get that idea. Okay, so you're locking in with your term a guaranteed cost for a period of time, but then the cost is going to renew astronomically higher. So term length, when term is suitable, if you have large family protection needs, pick a term length that mirrors, say, when your children are going to grow up and become self-sufficient, when you're going to be mortgage and debt-free. So if you know that's 20 years from now, then you may be better off with a 20-year term rather than a 10-year term. And you may not need a 30-year. Does that seem reasonable? Hopefully that makes sense to you. Okay? The other option, right? When you get term, normally it's going to have an expiry period. So newer plans nowadays, age 85, older plans expired younger. So if you outlive that plan, your coverage is going to end on a term plan. Normally good term plans have a convertibility period where they guarantee that based on your health here, you can convert your term into permanent with no medical evidence based on your health there. Sound good? For sure. Okay, nowadays you can convert up to age 75. Okay, on older plans it was often a younger age. However, keep in mind that if you wait till you're 74 to convert to permanent, that plan will cost a lot more than if you were 40, for example. Hopefully that makes sense. With permanent coverage, typically it's a level cost that never expires. So no matter how old you live to be, whether you pass away a month from now or 80 years into the future, but sooner or later it is going to pay out that tax-free death benefit. And you're essentially paying more than you need to in your younger years so that you don't pay escalating, increasing costs on a plan that expires down the road. And that extra pool of money building up is essentially the equity in your policy. Often you'll hear it referred to as cash value or cash surrender value. We'll dive deeper into different tax-exempt investment strategies that sometimes play out here. Right? People can do a policy loan, similar to taking a home equity loan. So there's options and flexibilities around that money. Thinking of it this way, term is like renting your protection. Permanent is like owning it and building value there. There's different scenarios where both will be better than the others. Often for large needs and temporary needs, term can be a good economical fit. For longer term lifetime needs, then permanent is typically a better fit. Hopefully that enlightens you a little bit on the differences. Look forward to diving deeper into some more topics as we go along. Hope you have an awesome day.